Our next guest has been calling for 100 basis points of cuts this year for months, long before we saw a downturn in the official jobs data. So what is he looking for this week, and how should investors position? With us is Barry Knapp, Ironsides Macroeconomics Director of Research. Barry, it's great to see you.
Good to see you again, Mike.
So it's an interesting take that you have here, that in other words, 100 basis points is warranted. I guess you would also say perhaps overdue. At the same time, we've been talking about how the markets seem to be treating this prospect of a quarter-point cut as a little bit of a bonus, like the economy's doing well, markets are at a high, financial conditions are loose, credit spreads are tight. You think that there's actually a little bit more to be addressed in the real economy here?
I think there's a lot more to be addressed. This has been a long-standing view of mine. I recall talking to Becky Quick about it in December of 21, and Kelly and I have spoken about this often, which is the Fed eased primarily using their balance sheet and tightened primarily using their rate policy. That created very, very tight financial conditions for floating rate, small businesses, small bank borrowers. Leslie, you'll like this. One of the biggest manifestations of this is the spread between return on equity of the regional bank index and the large banks has never, it's near historic wides at about 4%. So small banks are not earning their cost of capital, not creating credit, not buying securities, not making loans, and large banks are in a much stronger position. So again, you could see the same thing in the duration of the high yield index versus the investment grade credit index. The way the Fed tightened really hurt the small business sector. And we see that in the underperformance of the Russell 2000 over the last couple of years. So there is a part of the economy, housing is part of this, that desperately needs a steep yield curve. Last year, the 100 basis points of cuts merely took away the deep inversion of the curve. This year, it would steepen it, lower financing rates for floating rate borrowers, revive the housing market. We've already seen the spread of mortgages to treasuries tighten considerably, and really jumpstart Main Street, so to speak. So that part of the economy really needs it. And that's what the labor market weakness is all about. Mm-hmm. If you assume, which I would for sure, and it may have actually gotten worse, that overestimation of monthly job growth of nearly 80,000 jobs per month continued from April through August, and it probably got even bigger, then employment growth is zero. We arguably have a recession in the labor market, and we certainly have real struggles for small businesses. So that's what the Fed needs to address here. The financial conditions, because of the Fed's balance sheet, anybody who finances out the curve are still relatively loose, and the stock market benefits from that. But conditions for Main Street are really tight.